harvesting returns, unraveling the impact of seasonality on investment opportunities in specific markets. Introduction. In the kaleidoscopic world of finance, the concept of seasonality emerges as a subtle yet powerful force that influences investment opportunities across various markets. As investors tread the path of wealth creation, understanding how seasonality shapes market dynamics becomes imperative. This article delves into the multifaceted realm of seasonality, exploring its impact on investment decisions and unraveling the hidden patterns that savvy investors leverage to enhance their portfolios. The dance of seasons and markets. Seasonality in financial markets refers to the tendency of certain assets to exhibit recurring patterns or trends during specific times of the year. Just as nature experiences the ebb and flow of seasons, financial markets undergo rhythmic cycles influenced by a myriad of factors, including weather, holidays, and economic events. The discerning investor recognizes that beneath the surface of seemingly random market movements, there exists a rhythmic pattern waiting to be uncovered. Understanding seasonal trends. One of the most well-known instances of seasonality is the Santa Claus rally, observed in the stock market during the year-end holiday season. Historically, equity markets often experience a surge in buying activity in the weeks leading up to Christmas. Investors, buoyed by the spirit of optimism and the anticipation of positive economic developments in the coming year, contribute to a seasonal uptick in stock prices. Another classic example is the sell in May and go away phenomenon, where some investors strategically reduce their equity exposure during the summer months. Historically, market returns have shown a tendency to be weaker during this period, prompting investors to reallocate their portfolios to avoid potential downturns. Commodities and seasonal forces. Seasonality extends its influence to commodity markets, where agricultural products showcase distinct patterns tied to planting and harvesting seasons. For instance, the prices of grains such as corn and wheat often experience volatility during planting and harvest periods, reflecting the impact of weather conditions on crop yields. Similarly, the energy sector witnesses seasonal fluctuations in demand for heating oil in winter and gasoline in summer. Investors keenly attuned to these patterns can capitalize on seasonal trends, adjusting their portfolios to align with anticipated market movements. Real estate and seasonal shifts. The real estate market, too, dances to the tune of seasonality. Spring and early summer tend to be peak seasons for home buying, as favorable weather and longer daylight hours create an ideal environment for property transactions. Sellers, aware of this trend, often list their homes during these months to capitalize on higher demand. Conversely, the winter months may see a slowdown in real estate activity, with fewer buyers venturing out in inclement weather. Savvy real estate investors recognize these seasonal nuances, strategically timing their acquisitions or sales to align with the cyclical nature of the market. Global markets and cultural festivities. Beyond regional considerations, seasonality in investment opportunities is also influenced by cultural and religious festivities around the world. For example, during the Chinese New Year, markets in Asia often experience reduced trading volumes as participants take time off to celebrate. Understanding these cultural influences is crucial for investors with a global perspective, as market liquidity and dynamics can be significantly impacted during festive seasons. Investment strategies in light of seasonality. Armed with the knowledge of seasonal trends, investors can craft nuanced strategies to capitalize on market movements. Tactical asset allocation. where portfolio weightings are adjusted based on anticipated seasonal trends, is one approach. For instance, increasing exposure to defensive sectors during traditionally weaker market periods, or rotating into sectors with historically strong performance during specific seasons can enhance portfolio resilience. Options trading strategies, such as implementing covered calls or protected puts, can also be employed to navigate potential volatility associated with seasonal shifts. Investors may choose to align their option strategies with anticipated market movements during specific seasons, leveraging derivatives to manage risk and enhance returns. Risk factors and prudent considerations. While seasonality provides a valuable framework for investment decision-making, it is essential for investors to approach this concept with a degree of caution. Past performance is not always indicative of future results, and market conditions can evolve, rendering historical seasonal patterns less reliable. Additionally, unforeseen events, such as geopolitical developments or economic shocks, can override seasonal influences, introducing an element of unpredictability. Conclusion. In the intricate mosaic of investment opportunities, the concept of seasonality adds a layer of complexity and opportunity. Recognizing the rhythmic patterns that unfold in various markets throughout the year empowers investors to make informed decisions, strategically adjusting their portfolios to align with anticipated seasonal trends. Whether navigating the peaks and valleys of the stock market, harnessing the cyclical forces in commodity markets, or timing real estate transactions to the rhythm of the seasons, the astute investor embraces seasonality as a valuable tool in their quest for financial success. As the seasons change, so too do the dynamics of investment opportunities, inviting those with a keen understanding of seasonality to reap a bountiful harvest of returns.